Big banks are everywhere, offering convenience, apps, and a branch on every corner. But sometimes, that impersonal, automated approach just doesn't feel right. Maybe you want a banking experience that's more personal, more local, and more community-focused. If that sounds like you might want to consider a community bank or a credit union. But what's the difference between the two? And which one is right for you? Let's break it down. What is a community bank? Let's start with community banks. These are small, locally focused banks that serve the people and businesses in a specific area. Instead of pulling money from across the country, community banks keep their deposits and loans local. That means they know their customers, they understand the local economy, and they can be more flexible with things like loans. You'll find most of the same services as a big bank: checking and savings accounts, CDs, loans, and business banking. But since these banks are smaller, they usually have fewer branches and sometimes fewer online features than national banks. One big perk: personalized service. Since they aren't serving millions of customers, community banks can focus on relationships. That means when you apply for a loan, you're more than just a credit score, you're a person. What is a credit union? Now, let's talk about credit unions. At first glance, they look a lot like banks. They offer checking and savings accounts, loans, and even mortgages. But credit unions aren't banks at all, they're financial cooperatives. That means they are owned by their members, people like you. Instead of customers, you're a part owner. That also means you have a say in major decisions, like electing board members. But there's a catch: not just anyone can join a credit union. Membership is usually limited to people who live in a certain area, work for a specific employer, or belong to a particular group, like teachers, military personnel, or church members. Because they're not profit, credit unions focus on serving their members rather than making profits. That often means lower fees, higher interest rates on savings, lower loan rates. Credit unions are also known for their community involvement. Many offer financial education programs, scholarships, and local investments. Key differences between community banks and credit unions. So, now that we know what they are, let's compare them side by side. Eligibility: anyone can open an account at a community bank, but credit unions require membership with specific qualifications. Ownership: banks are for-profit businesses, credit unions are nonprofits owned by their members. Influence: at a bank, customers don't have a say in decisions. At a credit union, members can vote on important matters. Deposit insurance: community banks are insured by the FDIC, while credit unions are insured by the NCUA. Both protect deposits up to $250,000. Fees and rates: credit unions generally offer lower fees and better rates on loans and savings accounts. Technology and access: banks often have more locations, ATMs, and advanced mobile banking apps. Some credit unions participate in shared networks, allowing members to use partner branches and ATMs nationwide. Which one is right for you? So, how do you choose between a community bank and a credit union? It depends on what's most important to you. If technology, convenience, and easy access are top priorities, a community bank might be the better fit. If you want lower fees, better rates, and a say in how your financial institution is run, a credit union is a great option if you qualify for membership. Both of these options offer something you won't find at the biggest banks: a more personal, community-focused approach to banking. No matter what you choose, the most important thing is to pick a financial institution that fits your needs and values. After all, your money should work for you, not the other way around.